Ride-sharing giant Lyft and Levi's Jeans, they both recently had their initial public offerings, IPOs. Here to explain what an IPO actually is and whether or not you should invest in them, Brent Wilsey from Wilsey Asset Management. Morning, Brent.
Good morning, Jason.
We hear IPO and people get excited. I can get in on the ground floor.
Yes. And it is very exciting. Like, wow, you got a new company coming out. How exciting this is. I need to get in on that one because I want to get in the ground floor. Not the case anymore, because what's happening is that an IPO does stand for initial public offering. So it's the first time that the company comes to the public and you can be part of that big company. But the problem is, Jason, they're now staying in private equity much longer. So a lot of the good gains that people get before, they're not there because they'll stay private for 2, 3, 4 years. Like Uber's been out for 4 or 5 years. Now they come to the public after the big gain is there.
So where is the money to be made in an IPO?
Good question. There's really not, and that's the concern. That's why I'm talking about this, because there's over 270 IPOs coming out this year. 9 big ones. We had one already. The Lyft IPO came out. About $700 billion of IPOs coming out. So a lot of chances, I think, for people to make a mistake by investing in what they think is the first time the company's going to public, which is true, but not the first time you've been able to invest in that company privately.
Now let me ask you this. You are a financial expert. You manage a lot of accounts. How often do you buy IPOs?
Let me think. Never.
You really? Seriously?
Really, seriously. Because most of them do not make money. We're very conservative with our clients' money. We like to make sure we make our clients' money. And most of them, if not all the IPOs, I can't remember an IPO coming out that actually they were profitable. They're coming to market because generally they need money to build their company, so therefore they don't have the profits yet. So we're too conservative. We stay away from that. There are some very good IPOs. I mean, Google was good. Facebook eventually became good. But there was ones that weren't good, like Snap, GoPro. These are ones, and there's many that people lose money on. And I did invest in one, I think like 25 years ago in the beginning when I was investing, and lost money for the guy, so I never did it again.
Well, does Wall Street profit from IPOs?
Great question, Jason, because what actually happens is that most of the money from the IPOs used to go to the company to raise capital so they could expand and so forth. Well, because they're staying private so long now, what's actually happening is that there's many shareholders in the company and investors, like in Lyft, GM was a holder as well, that they benefit from that. So the money going into that IPO, and you see like a $50 billion going, a lot of that's going to the company shareholders that got in privately, not going to the business.
It's just a lot of moving parts and too much risk, huh?
A lot of confusion for people, and another thing too on the voting. Many of these companies now are coming out with super voting, and that means that you as a shareholder, you don't really get to vote the CEO in or out or anything with the company. They have these super voting rights that allows the executives to vote without you being part of it.
Interesting. All right. Any seminars coming up?
Yeah, actually we do. On Thursday, April 25th, just a few weeks away, 6:30 at Scripps Ranch. And address to go to that is smartinvesting2000.com.
Yes, it is. All right, Brent Wilsey, Wilsey Asset Management. Thanks, Brent. Appreciate it. Well, spring has arrived, and that means so has allergy season. After the break, we've got a health expert here to explain natural remedies for your allergies. Keep it right here. Good Morning San Diego's coming right back.